Hello everyone, I am Munir Muhammad Munir, teaching assistant at Faculty of Commerce, Cairo University. Today we are going to make a revision of Cost Accounting 1. Let's start by Chapter 1. Chapter 1, the Manager and Management Accounting. Financial Accounting focus on external users and GAAP rules. Managerial Accounting focus on internal users and do not have to follow GAAP. It also provides data for financial accounting. This includes cost accounting and cost management. Cost accounting is a process of measuring, analyzing, and reporting financial and non-financial information related to the costs of acquiring or using resources in an organization. For example, calculating the cost of a product is a cost accounting function that meets both the financial accountant's inventory valuation needs and the management accountant's decision-making needs. Cost management. Cost management is used to describe the activities managers undertake to use resources in a way that increase a product's value to customers and achieves an organization's goals. Cost management decision examples: improve customer satisfaction and quality, whether or not to enter new markets, change product designs, develop new products. Now let's see some major differences between financial and managerial accounting. The purpose of managerial accounting is to help managers make decisions, while financial accounting its purpose to communicate financial position. Primary users of managerial accounting are internal managers, while primary users of financial accounting are external stakeholders. The focus of managerial accounting is future-oriented, while financial accounting its focus is past-oriented. Managerial account rules is cost-benefit, while financial accounting must follow GAAP rules. Time span of managerial accounting varies, while financial accounting annual or quarter. Management accounting and value. Creating value is an important part of planning and implementing strategy. Value is the usefulness a customer gains from a company's product or service. Value chain is a sequence of business functions in which customer usefulness is added to products or service. Value chain starts with research and development, then design of products and process, then production, then marketing, then distribution, and finally customer service. Let's solve an exercise on value chain. Value chain and the classification of costs. Computer company Combat Computer incurs the following: A. Electricity costs for the plant assembling the Presero computer line of products. Electricity costs should be classified to production. B. Transportation costs for shipping the Presero line of products to a retail chain. Transportation costs will be related to distribution. Payment to David Kelly Designs for design of the Armanda notebook. Designs will be related to design of products. Salary of computer scientists working on the next generation of mini computers will be research and development. Cost of Compaq employees' visit to a major customer to demonstrate Compaq's ability to interconnect with other computers, could be marketing or customer service. Purchase of competitors' products for testing against potential Compaq products will be design of products or research and development. Payment to television network for running Compaq advertisement will be marketing. Cost of cables purchased from outside supplier to be used with Compaq printers will relate to production. Let's solve another exercise. Value chain and the classification of costs. Fast food restaurant. Cost of oil for the deep fryer will relate to production. Wages of the counter help who give customers the food they order will be distribution. Cost of the costume for the king on the Burger King television commercials will be marketing cost. Cost of a children's toys given away free with kids' meals will be marketing costs. Cost of the posters indicating the special 2 cheeseburgers for $2.5 will also be marketing costs. Costs of frozen onion rings and French fries will be production cost. Salaries of the food specialists who create new sandwich for the restaurant chain could be design of products or research and development. Cost of to-go bags requested by customers who could not finish their meals in the restaurant will be customer service cost. Now let's solve some true and false statement. Number 1. Management accounting is not particularly constrained by generally accepted accounting principles. This is true. Cost accounting provides information for management accounting, but not for financial accounting. This statement is false. Managers use feedback to examine past performance and systematically explore alternative ways of making better informed decisions in the future. True. The term supply chain describes the flow of goods, services, and information from the initial sources of materials and services to the delivery of products to customers, regardless of whether those activities occur in the same organization or in other organizations, and this is true. Now let's solve some MCQ questions. Number 1. Which of the following groups would be least likely to receive detailed management accounting reports? Stockholders, sales managers, production supervisors, distribution managers. Right answers: A. Stockholders. Number 2. Which of the following is true of financial accounting information? It is prepared based on cost-benefit analysis. It is primarily used by managers to make internal business decisions. It focuses on the past-oriented financial performance of a company. It only measures the cash transaction of the company. And the correct answer is C. Which of the following differentiates cost accounting and financial accounting? The primary users of cost accounting are the investors, where the primary users of financial accounting are the managers. B. Cost accounting deals with product design, production, marketing strategy, where financial accounting deals mainly with pricing of the products. C. Cost accounting measures only the financial information related to the costs of acquiring fixed assets in an organization, where financial accounting measures financial and non-financial information of a company business transactions. D. Cost accounting measures information related to the costs of acquiring or using a resource in an organization, where financial accounting measures a financial position of a company to investors, banks, and external parties, and the correct answer is D. Now let's move to Chapter 2, an introduction to cost terms and purposes. Basic cost terminology. Cost is a sacrificed or used resource to achieve a specific objective. For example, it might cost $5,000 per month to rent retail space in a shopping center. Actual cost is a cost that has occurred. Budgeted cost is a predicted cost to be paid in the future. Cost object is anything for which a separate measurement of costs is desired. Examples of cost objects at BMW factory: product, a BMW X6 car; service, hotline providing information to BMW dealers; project, research and development project on enhancing the DVD in BMW cars; activity, setting up machines for production; department, environmental health and safety department; cost accumulation is a collection of cost data in an organized manner. Cost assignment is a general term that includes tracing accumulated costs with a direct relationship to the cost object and allocating accumulated costs with an indirect relationship to cost object. Direct and indirect costs. Direct costs are related to the particular cost object and can be traced to it in an economically feasible way. For example, the cost of steel or tires is a direct cost of a BMW X6. Indirect costs are related to the particular cost object but cannot be traced to it in an economically feasible way. Instead of being traced, these costs are allocated to a cost object. For example, lease cost for the BMW plant, where BMW makes the X6 and other models of cars. Cost examples: direct costs like materials, labor; indirect costs like electricity, rent, property taxes. Now let's solve some MCQ questions on Chapter 2. Cost system determines the cost of a cost object by accumulating and then assigning cost, accumulating costs, assigning and then accumulating cost, assigning cost. Correct answer is A, accumulating and then assigning cost. Classifying a cost as either direct or indirect depends upon the behavior of the cost in response to volume changes, whether the cost is expensed in the period in which it is incurred, whether the cost can be easily traced with the cost object, whether a cost is fixed or variable, and the correct answer is C, whether the cost can be easily traced with the cost object. The general term used to identify both tracing and allocating of accumulated costs to cost object is cost accumulation, cost assignment, cost tracing, conversion cost, and the correct answer is B, cost assignment. Cost accumulation is a collection of cost data in some organized way by means of an accounting system. Anything for which a cost measurement is desired, anything for which a profit measurement is desired, the collection of profit data in some organized way by means of an accounting system, and the correct answer is A, collection of cost data in some organized way by means of an accounting system. Each of the following statements about the direct, indirect cost classification is true. Indirect costs are always traced. Indirect costs are always allocated. The design of sales target affects the direct-indirect classification. The direct or indirect classification depends on the cost control measure, and the correct answer is B. Indirect costs are always allocated. Cost tracing is the assignment of direct cost to the chosen cost object. Function of cost allocation, the process of tracking both direct and indirect costs associated with a cost object, the process of determining the actual cost of the cost object, and the correct answer is A, the assignment of direct cost to the chosen cost object. Cost allocation is a process of tracking both direct and indirect costs associated with a cost object, the process of determining the opportunity cost of a cost object chosen, the assignment of indirect cost to the chosen cost object, made based on material acquisition document, and the correct answer is C, the assignment of indirect cost to the chosen cost object. The determination of cost as either direct or indirect depends upon the accounting standard, tax system chosen, inventory valuation, cost object chosen, and the correct answer D, cost object chosen. Cost behavior. Variable costs. It changes in total in proportion to changes in the related level of activity or volume. Fixed costs remain unchanged in total regardless of a change in the related level of activity or volume. Variable costs are constant on a per unit basis. If a product takes 5 pounds of materials each, it stays the same per unit regardless of whether 1, 10 or 1000 units are produced. Fixed costs change inversely with the level of production. As more units are produced, the same fixed cost is spread over more and more units, reducing the cost per unit. Cost behavior summarized. Variable cost, a change in proportion with output, more costs. This is variable cost as a total cost, while variable cost per unit is unchanged in relation to output. Fixed costs as a total fixed cost unchanged in relation to output. Fixed cost per unit change inversely with output, more output equal lower cost per unit. Let's solve an exercise. If the variable cost per unit equal $5 and fixed cost per unit equal $5, while units produced equal 120 units, calculate total cost of producing 180 units. When units produced equal 120 units, total fixed cost will equals to $5 multiplied by 120 equals to 600. So total fixed cost equals to 600, while variable cost per unit that will remain constant will equals to $5. When units produced equal 180 units, total fixed cost will remain the same, 600, while total variable cost will equals to 5 multiplied by 180 equals to 900. So total cost of producing 180 units will equals total fixed cost 600 plus total variable cost 900, which equals to total cost 1500. Different types of firms. Manufacturing sector, companies create and sell their own products. Merchandising sector, companies product resellers. Service sector, companies. Types of inventories. Direct materials, resources in stock and available for use. Work in process are products started but not yet completed. Finished goods are products completed and ready for sale. Types of product costs: direct materials, direct labor, indirect manufacturing are factory costs that are not traceable to the product, also known as manufacturing overhead costs or factory overhead costs. Distinctions between costs: inventoriable costs are product manufacturing costs. These costs are capitalized as assets or inventory until they are sold and transferred to cost of goods sold. Period costs have no future value and are expensed as incurred. Other cost considerations: prime cost is a term referring to all direct manufacturing costs, labor, and materials. Conversion cost is a term referring to direct labor and factory overhead costs. Now let's start Chapter 3, Cost Volume Profit Analysis. Cost Volume Profit terminology: operating income equals total revenues from operations less cost of goods sold and operating costs excluding income taxes. Net income equal operating income minus income taxes. Cost volume profit contribution margin. Manipulation of the basic equations yields an extremely important and powerful tool extensively used in cost accounting, which is contribution margin. Contribution margin equals revenue less variable costs. Contribution margin per unit equals unit selling price less unit variable costs. You can also calculate contribution margin, which is equal to contribution margin per unit multiplied by number of units sold. Contribution margin percentage, which is the contribution margin per unit divided by unit selling price, or contribution margin divided by revenues. Cost volume profit equation: revenues minus variable cost minus fixed costs equal operating income. Revenues calculated by selling price multiply quantity of units sold. Variable cost calculated by unit variable cost multiplied by quantity of units sold. Fixed costs is total fixed costs, and this will give the operating income. So operating income can be calculated by contribution margin less fixed costs. Break-even point. At the break-even point, a firm has no profit or loss at the given sales level. Break-even is where sales minus variable cost minus fixed cost will equals to 0. Calculation of break-even number of units equals total fixed cost divided by contribution margin per unit. Calculation of break-even revenues will equals to fixed cost divided by contribution margin percentage. Using break-even for profit planning, the break-even point formula can be modified to become a profit planning tool by adding target operating income to fixed costs in the numerator. Quantity of units required to be sold will equals to fixed cost plus target operating income divided by contribution margin per unit. Cost volume profit and income taxes. After tax profit or net income can be calculated by net income will equals to operating income multiplied by 1 minus tax rate. So net income can be converted to operating income for use in cost volume profit equation. So operating income will equals to net income divided by 1 minus tax rate. Sensitivity analysis. Cost volume profit provides a structure to answer a variety of what-if scenarios. What happens to profit if selling price changes, volume changes, cost structure, it changes as variable cost per unit change or fixed cost change. Margin of safety. The margin of safety calculation answers a very important question. If budgeted revenues are above the break-even point, how far can they fall before the break-even point is reached? In other words, how far can they fall before the company will begin to lose money? As an indicator of risk, the margin of safety measures the distance between budgeted sales and break-even sales. So margin of safety equal budgeted sales minus break-even sales. Managers make strategic decisions that affect the cost structure of the company. The cost structure is simply the relationship of fixed cost and variable cost to total costs. We can use cost volume profit based sensitivity analysis to highlight the risks and returns as fixed costs are substituted for variable costs in a company cost structure. The risk-return trade-off across alternative cost structures can be measured as operating leverage. Operating leverage describes the effect that fixed costs have on changes in operating income as the changes occur in units sold. Organizations with a high proportion of fixed costs have a high operating leverage. Operating leverage equals to contribution margin divided by operating income. Now let's solve some exercises on the previous three chapters. Ahmad Company recorded the following manufacturing costs in the accounting period just ended. Direct materials $20,000, direct labor $40,000, manufacturing overhead $50,000, selling and administrative costs $24,000. Number 1. Calculate Ahmad Company's total conversion cost. Conversion cost equals to direct labor plus manufacturing overhead. So direct labor 40,000 plus manufacturing overhead 50,000 will equals to 90,000. Number 2. Calculate Ahmad Company total manufacturing costs. Total manufacturing cost is the same as inventoriable cost, which equals to direct materials plus direct labor plus manufacturing overhead. So direct material 20,000 plus direct labor 40,000 plus manufacturing overhead 50,000 equals to 110,000. Calculate Ahmad Company prime cost. Prime cost equals direct material plus direct labor. Direct material 20,000 plus direct labor 40,000 will equals to 60,000. Amr Manufacturing Corporation provided the following information for last month. Sales 40,000, variable costs 14,000, fixed cost 10,000. If sales reduce to half of the amount in the next month, what is the projected operating income? Before we see the change, if sales reduce to half, we need to calculate operating income for original data. Sales minus variable cost minus fixed cost. So operating income equals 40,000 minus 14,000 minus 10,000, which equals to 16,000 operating income. If sales reduce to half of the amount in the next month, means sales will equals to 20,000 instead of 40,000, and also variable cost will reduce to half to be 7,000 instead of 14,000, and fixed cost will remain the same. So now 20,000 minus 7,000 minus 10,000, operating income will equals to 3,000. Sabri Company reported the following: manufacturing costs 2 million, units manufactured 50,000 units, units sold 47,000 units, 475 as a selling price per unit, beginning inventory 0 units, no beginning inventory, and the required is what is the amount of gross profit margin. Manufacturing cost per unit will equals to 2 million divided by number of units manufactured, so the cost per unit will equals to $40 per unit. Gross profit margin equals to sales revenue minus cost of goods sold. Sales revenue is calculated by multiplying 47,000 as a unit sold multiplied by selling price 75 per unit minus cost of goods sold. Here we calculated cost per unit 40 multiplied units sold 47,000, so 47,000 multiplied by 75 minus 47,000 multiplied by 40, which equals to 1,645,000. The North Company manufactured several different products. Unit cost associated with product HAN 210 are as follows: direct materials 54, direct manufacturing labor 8, variable manufacturing overhead 11, fixed manufacturing overhead 25, sales commission 2% of sales, administrative salaries equal 12. Required is what are the period cost per unit associated with product HAN 210, HAN 210, not 203. Period cost will equals to sales commission plus administrative salaries, 5 plus 12 equals to 17. Another exercise. For last year, Tar Enterprise reported revenues 420,000, cost of goods sold 108,000, cost of goods manufactured 101,000, and total operating costs of 70,000. Operating income for that year was operating income will equals revenues less cost of goods sold less operating costs. So revenues 420, cost of goods sold 108,000, and operating costs 70,000. So operating income will equals to 242,000. Beginning finished goods 92,000, ending finished goods 75,000, cost of goods sold 300,000, sales revenue 450,000, operating expenses 95,000. This is a given. Requirement: what is the cost of goods manufactured for 2015? We know that cost of goods sold equals cost of goods manufactured plus beginning finished goods minus ending finished goods. So to calculate cost of goods manufactured, this will equals to cost of goods sold minus beginning finished goods plus ending finished goods. So cost of goods manufactured equals cost of goods sold 300,000 minus beginning finished goods 92,000 plus ending finished goods 75,000, which equals to 283,000. Now we need to calculate the gross margin for 2015. Gross margin will equals to sales revenue minus cost of goods sold. Sales revenue 450,000 and cost of goods sold 300,000. So gross margin will equals to 150,000. Now we need to calculate the operating income for 2015. Operating income equals gross margin previously calculated 150,000 minus operating expenses given by 95,000. So operating income will equals to 55,000. Magdi sells 8,000 units, resulting in 100,000 sales revenue, 35,000 variable cost, and 45,000 fixed cost. To achieve 150,000 in operating income, sales must total. So, first, we need to use the rule of break-even in sales. So, break-even in sales rule equals fixed cost divided by contribution margin percentage. To calculate contribution margin percentage, we need first to calculate contribution margin, and to reach contribution margin we need to know the selling price and the variable cost per unit. So selling price equals 100,000, which is the sales revenue, divided by number of units sold, 8,000 units. So the selling price will equals to 12.5. Variable cost per unit will equals to 35,000 divided by 8,000, which equals to 4.375. So contribution margin will equals to 12.5 minus 4.375, which equals to contribution margin per unit 8.125. Contribution margin percentage will equals to 8.125 divided by 12.5, which equals to 65%, and this is the contribution margin percentage. Or it can be calculated by sales revenue 100,000 less total variable cost 35,000 divided by sales revenue 100,000. So 100,000 minus 35,000 will equals to 65,000 divided by 100,000 will also equals to 65%. Both are correct. So targeted sales will equals to fixed cost plus operating income divided by contribution margin percentage. Fixed cost given 45,000 plus target operating income 150,000 divided by 65%, and this will equals to targeted sales 300,000. The past year's sales were 540,000 for the Max company. The gross margin for the same year was 155,000, and the cost of goods manufactured was 350,000. If beginning finished goods inventory was 50,000, so ending finished goods inventory must have been. We also know that cost of goods sold equal cost of goods manufactured plus beginning finished goods minus ending finished goods. So to calculate ending finished goods, this will equals to cost of goods manufactured plus beginning finished goods minus cost of goods sold. Cost of goods manufactured equals to 350 plus beginning finished goods 50,000. Cost of goods sold is not given, but here sales revenue is given 540,000 and gross margin is given 155,000. So sales revenue minus gross profit or gross margin will equals to cost of goods sold. So ending finished goods will equals to 15,000. Pickup company has the following information available: selling price per unit 100, variable cost per unit 55, fixed costs per year 400,000, expected sales per year 20,000 units. So what is the expected operating income for the year? Operating income equals sales revenue minus variable cost minus fixed cost. Sales revenue equals to 100 multiplied by 20,000 units. Variable cost will equals 55 multiplied by 20,000 units, and fixed cost is given by 400,000. So operating income will equals to 500,000. Assume the following information for Janet's company. Selling price per unit 100, variable cost per unit 80, total fixed cost 80,000. If fixed costs increased by 10% and management wanted to maintain the original break-even point, then the selling price per unit would have to be increased to. First, we need to calculate break-even on the original data before any increase or decrease. So break-even will equals to fixed cost divided by contribution margin. Fixed cost 80,000 given divided by contribution margin calculated by selling price minus variable cost per unit. So 100 minus 80. So 80,000 divided by 20 will equals to 4,000 units. If fixed cost increased by 10%, this means fixed cost will equals to 80,000 multiplied by 110% divided by selling price, which we need to calculate, minus 80 variable cost per unit equals to 4,000 units. So selling price will equals to 102. For the company has budgeted sales of 120,000 based on 80,000 units. Margin of safety is 1,000. What is the break-even point in dollars? Margin of safety equals sales revenue minus break-even point in dollars. Break-even point in dollars equals 120,000 minus 1,000 equals to 119,000. Winston Company has variable cost of $5 per unit and selling price $10 per unit. Fixed costs are 100,000. Planned unit sales for 2015 are 25,000 units. Actual unit sales for 2014 were 22,000 units. What is the margin of safety in units for 2015? Break-even in units equal fixed cost divided by contribution margin. Fixed cost 100,000. Contribution margin selling price minus variable cost. Selling price is 10, variable cost 5. So break-even units will equals to 20,000 units. Margin of safety equal budgeted units minus budgeted units. Minus break-even units. So margin of safety 25,000 minus break-even units 20,000, which equals to 5,000. Chapter 9: Inventory Costing and Capacity Analysis. In this chapter, we prepare income statement using variable cost and absorption cost. Variable cost-based income statement starts with revenues less variable cost of goods sold less variable period cost, which equals to contribution margin less fixed product cost less fixed period cost to reach operating income. Under the absorption costing, revenues less cost of goods sold equals to gross margin less variable period cost less fixed costs will equals to operating income. Let's see an exercise on preparing income statement using absorption and variable costing methods. The following data pertain to XYZ factory. Sales price $8 per box. Units sold 40,000 boxes. Direct material $3 per box. Direct labor 0.5 per box. Variable manufacturing overhead equals 0.25 per box. Fixed manufacturing overhead equals 100,000 per year. Sales commission 0.75 per box. Fixed administrative expenses 30,000 per year. And actual production 50,000 boxes. First, what is the cost per box under variable costing? Under variable costing, we calculate direct material plus direct labor plus only the variable part of manufacturing overhead. So direct material is 3 plus direct labor 0.5 plus variable manufacturing overhead will equals to 3.75. What is the cost per box under absorption costing? Under absorption costing, we calculate direct material plus direct labor plus the variable and the fixed part of manufacturing overhead. So it is the same as variable plus the fixed part of manufacturing overhead, which equals to 2 calculated by dividing the 100,000 total fixed overhead divided by 50,000 boxes, which is the number of units produced, will equals to 2 per unit. So now the cost per box under absorption costing will equals to 5.75. Preparing income statement using absorption costing, selling price equals to 8, which sales revenue will equals to 8 selling price per unit multiplied by units sold. 40,000 units will equals to 320,000. Cost of goods sold, we calculate here cost per unit under absorption 5.75. So cost of goods sold will equals to 5.75 multiplied by 40,000, which equals to 230,000. So gross margin will equals to sales revenue minus cost of goods sold equals to 90,000. Then turning back to the given, here we have fixed administrative expenses 30,000 per year and sales commission 0.75 per box, and number of units sold equal 40,000 boxes. So period cost will equals to 30,000 plus 0.75 multiplied by 40,000 will equals to 30,000 plus 30,000 equals to 60,000. Here 60,000. So gross margin less period cost will equals to operating income 30,000. While variable costing, sales revenue, the same, 8 multiplied 40,000, 320,000. Variable cost 3.75 calculated here, 3.75 per unit multiplied by 40,000 equals to 150,000. Here sales commission 0.75 multiplied by 40,000 equals to 30,000. Contribution margin, sales revenue less variable cost less sales commission. So contribution margin will equals to 140,000. Fixed costs 130,000 calculated by here fixed manufacturing overhead 100,000 plus fixed administrative expenses 30,000. So total fixed cost 130,000. So operating income will equals to 10,000. Chapter 10, determining how costs behave. Cost estimation method. Number 1, industrial engineering method. Number 2, conference method. Number 3, account analysis method. Number 4, quantitative analysis methods. Number 1, in the quantitative analysis method, high-low method. Number 2, regression analysis. High-low method is the simplest method of quantitative analysis, uses only the highest and lowest observed. The linear cost function y equal a plus bx. Y is a dependent variable, the cost that is being predicted. A is the intercept, fixed costs. B is the slope of the line, which represent variable cost per unit, and x is the independent variable, which is the cost driver. Let's see simple example. Estimating a cost function. The controller of the Igeri company wants you to estimate a cost function from the following two observations in a general ledger account called maintenance. Maintenance costs incurred for the month of January $4,000 where machine hours were 6,000. Maintenance costs incurred for the month of February equals to $5,400, while machine hours were 10,000 hours. Now we need to estimate the cost function for maintenance. So the slope coefficient equals difference in costs divided by difference in machine hours. Difference in costs associated with the highest month, which is February, and the lowest month, which is January. For February, the highest machine hours 10,000 and the lowest is 6,000. Maintenance costs for February 5,400 minus 4,000 costs of January, the lowest cost, so 5,400 minus 4,000 divided by 10,000 minus 6,000 equals to 0.35 per machine hours, and this is the slope. So to calculate the constant or the fixed cost, constant will equals to total costs minus the slope coefficient multiplied by quantity of cost driver. Let's substitute in the second equation. 5,400 is the total cost minus slope 0.35 multiplied by 10,000 hours equals to 1,900. To make sure of the answer, we can substitute in the first equation. So total costs here 4,000 minus 0.35, the slope coefficient, multiplied by 6,000 hours will equal the same fixed cost 1,900. So the cost function based on the two observations is maintenance costs equals to 1,900 plus 0.35 multiply machine hours. Now the last chapter, chapter 15, allocation of support department costs, common costs, and revenues. Allocating costs of a supporting department to operating departments. Supporting or service department provides the services that assist other internal departments in the company. Operating or production department directly adds value to a product or service. Methods of allocating support costs to production departments. Number 1, direct. Number 2, step down. And number 3, reciprocal method. Direct method allocates support costs only to operating department. So under direct methods, only the support costs are allocated to operating department and no interaction between supported departments prior to allocation. So direct method allocate support department costs to the different production departments and no interaction between the supporting departments. Step down method allocates support costs to other support departments and to operating departments, but one-way interaction between supported departments prior to allocation. So under step down method, supported department cost will be allocated to the different production department, but only a one-way allocation will occur between the two support departments. Reciprocal method allocates support department cost to operating departments by fully recognizing the mutual service provided among all support departments. So a full two-way interaction between supported departments prior to allocation. So here supported departments cost will be allocated to the different production departments and also there is a two-way interaction between the two supporting departments. Now let's solve an exercise by the three different methods to see the difference between them. A company has two products. Product 1 is manufactured entirely in Department X, and Product 2 is manufactured entirely in Department Y. To produce these two products, the company has two support departments, Department A, which is a material handling department, and Department B, a power generating department. Here is an analysis of the work done by Departments A and B in a typical period as follows. Here, Department A and Department B, supplied by and used by. Work supplied by Department A to Department B is 100. Work supplied by Department A to Department X is 250. Work supplied by Department A to Department Y is 150. For Department B, work supplied to Department A equals 500. Work supplied by Department B to Department X equals to 100. Work supplied by Department B to Department Y equals to 400. The work done in Department A is measured by the direct labor hours of materials handling time, and the work done in Department B is measured by the kilowatt hours of power. The budgeted costs of the supported departments for coming year are as follows. Variable indirect labor and indirect material costs for Department A 70,000 plus supervision 10,000 plus depreciation 20,000. So the total cost of the Department A equals to $100,000. For Department B, variable indirect labor and indirect material costs equals to 10,000, supervision 10,000, depreciation 20,000. So total cost of Department B will equals to 40,000. If we need to allocate the supporting department costs using the direct method, will be as follows. The total cost of Department A is 100,000 and total cost of Department B is 40,000. Now we need to allocate the 100,000 in Department A to the other operating department, Department X and Department Y as a direct method say. So 100,000 now will be allocated, so it will be deducted from the cost of Department A and allocated to Department X and Department Y. Here's the work supplied by A to Department X is 250 and Department Y is 150. So the total work supplied by A to the two departments equals to 25 plus 150 equals to 400. So to allocate the costs 100,000 of Department A to Department X, we will multiply 100,000 multiplied by 250 divided by 400, which equals to 62,500. And the same for Department Y, 100,000 multiplied by 150 divided by 400, which equals to 37,500. Now 100,000 is deducted from Department A and no cost for Department A, and it will be charged by these amounts to Department X and Department Y. For the second supporting department, Department B, we will do the same. We have here total cost of 40,000 will be deducted from Department B and allocated to Department X and Department Y. Work done by or supplied by Department B to X is 100 and to Y is 400. So total work supply to X and Y equals to 500. So to allocate 40,000 to department X, we will multiply 40,000 multiplied by 100 over 500. And to allocate 40,000 to department Y, it will be multiplied by 400 divided by 500. Same exercise, but we use the second method, step down, and allocating A first. Step down, we allocate the supporting department we start with to the other supporting department and to the operating department. So the difference here, we will deduct the 100,000 from the supporting department A, but it will be charged to the other support department B and then to X and Y. So here 100,000 is a cost, and the work done or supplied by A for B and X and Y will equals to 250 plus 150 plus 100, so total equals 500. So allocating 100,000 to B equals 100,000 multiplied by 100 divided by 500 equals to 20,000. Allocating 100,000 to X will equals 100,000 multiplied by 250 divided by 500 equals 50,000. Allocating 100,000 to Y equals 100,000 multiplied by 150 divided by 500 equals to 30,000. Now no cost in department A. The second department B is the second supporting department, and we said that the step down method, it is a one-way communication between the supporting department. So no costs of department B will allocated to department A, but costs of department B will be charged only to the operating department X and Y. Now the cost of department B 40,000, and it is charged by more 20,000 from A. So total costs now is 60,000 that will be allocated to X and Y. Total work supplied by B to X and Y equals 500. So 60,000 multiplied by 100 divided by 500 equals 12,000 charged to X, and 60,000 multiplied by 400 divided by 500 will equals to 48,000 charged to department Y, and now no cost in department B. Now we use also step down method, but allocating B first. If we allocate B first, B will be allocated to A and X and Y, then A will be allocated only to X and Y. Let's see, now we will allocate the 40,000 cost of B to A, X and Y. Work supplied by B to A, X and Y equals to 500 plus 100 plus 400 equals to 1000. So for A, this will equals to 40,000 multiplied by 500 divided by 1000, which equals to 20,000. And for X, 40,000 multiplied by 100 divided by 1000 equals 4,000. And for Y will equals to 40,000 multiplied by 400 divided 1000 equals to 16,000, and now no cost in B. Under step down, the second supporting department now will be allocated to X and Y. A first, it has 100,000 and charged by more 20,000. So now total cost to be allocated is 120,000 to be allocated between X and Y. 120,000 by A supply 25 plus 250 plus 150 totals 400. So allocating 120,000 multiplied by 250 divided by 100 and 150 divided by 100 to be allocated to X and Y. Last method, reciprocal method. First, we need to calculate the total cost that will be allocated from Department A and Department B. So we make an equation. Let A equal total cost of materials handling department and B total cost of power generating department. So A will equals total cost of material handling 100,000 plus 0.5 B, and B equals 40,000 plus 0.2 A. 0.5 and 0.2 calculated here in the first equation. A equal 100,000 plus how much from B? B supply to A 500. 500 out of 1000, so 500 divided by 1000 equals 0.5 B supplied to A or used by A. And the same for B, 0.2 A, as A give B 100 out of 500, which equals 100 divided by 500, which equals to 0.2 A. Substituting in 1, A will equals to 133,333 and B will equals to 66,666. These are the total costs for A and B that need to be allocated. Now we will allocate A first. First we wrote the original cost 100,000 and 40,000. Then we allocate the cost that calculated before 133,333. It will be allocated to B, X and Y by percentage 20%, 50% and 30% calculated from here. 100 divided by 500, 20%. 250 divided by 500, 50%. 150 divided by 500 will equals to 30%. Then we will allocate B to A, X and Y using percentage from here. 500 divided by 1000, 50%. 100 divided 100 divided 1000 equals 10%. 400 divided by 1000, 40%. And there will be no cost for A and B, the supporting department, and it will be charged only to the operating department X and department Y. And this is the end of our revision, and wish you good luck in your exams.